So, I did not dream about a career in financial services. From third grade until my freshman year of college, I wanted to be an electrical engineer. I was so excited to go to school at NDSU. And then I had my first course, digital systems. Studying binary code and ones and zeros just wasn't exciting to me. I quickly realized that I wanted to interact more with people in making my impact on the world. Even though it took several major changes and I finally double majored in business and marketing, it wasn't until getting laid off from a job that I started my career in financial services. I want you to keep that in mind when we're going through this information. This isn't something that came naturally to me. I definitely, in my first job, took that packet of benefits information and put it in a drawer and didn't know what to do with it. So remember, everybody's situation is unique. We all have different goals, and it's really important to work with a financial professional that can help you understand your situation and your goals. There isn't a cookie cutter solution. The goal for you today in the material we're going to cover is for you to understand what are your next steps based on where you're at now, and what are those things that you can control. We're first going to start with a visualization exercise. This is really an important piece of your retirement picture. What does retirement look like to you? Have you thought about this? You've handed in your laptop and your keys, and now every day is Saturday. You get to enjoy those things that you've been wanting to do your entire life on a regular basis. Does that look like traveling the world? Are you going to be with your grandkids? Do you enjoy gardening at home? Maybe it means getting a part-time job that brings you joy. I loved hearing from a client that was looking forward to delivering flowers in her retirement years. She had worked a high-stress job for years and wanted something that would bring people joy. Now, why does it matter to visualize what retirement looks like? Why am I asking you to really clarify that vision? Well, one of the most common questions that I hear is, how much do I need to have saved for retirement? When I decide at 60 or 65 or 70 that I'm ending my working career, how much do I need to have so I know that I'll be okay, that I can live that lifestyle I want? And what I'll tell you is that it depends. It depends because each of those different lifestyles I mentioned costs a significantly different amount of money. If you're going to travel the world versus staying home and enjoying gardening and staying local, that dollar amount looks quite a bit different. So you really need to understand, what does that look like to you and what lifestyle do you want to have? And when I talk about visualizing that and taking the time to really plan for that future, think about how much time we spend planning for other events in our lives. A wedding that lasts one day, we may have spent 12 months or even 18 months planning for. A vacation that lasts a week might have spent 3 or 6 months planning for that. Retirement could last decades. How much time have you put into planning for that? If you think about if you retire at 65, you could easily live till 85. That's 2 decades. So make sure you're taking the time to actually plan and actively be involved and really see, what does retirement look like to you? So we've heard about a lot of different concepts today, and we're really going to look at, how does retirement fit into your overall financial wellness picture? We're going to look at a financial pyramid. So earlier, you've heard about your credit, and budgeting, and setting goals and investing. Well, when we're looking at our financial picture, it really starts with our income and that budget. There's so much money coming in, and we want to make sure that more than that isn't going out. We want a strong financial foundation for those unexpected events in life. We talked about saving for that emergency fund. So if something unexpected occurs, you're able to pay for that and not impact your credit score, not struggle with debt. So really think about this is building up. Where are you at now? Do you have a strong foundation where you're protected from an unexpected illness or something like needing tires? And then are you starting to save for your goals? Maybe it's that vacation house and maybe it's retirement. Really think about where are you at now? Maybe you started saving for retirement with your first job. You've been saving for the last 10 or 15 years, and maybe you're just getting started. You've had other things that you've focused on, like building up that emergency fund or paying off debt, and it's time that you're ready to get started. No matter where you're at, it's important that you're taking that active role in your financial wellness journey. So there are certain tools available to help you save for your retirement goals. We're going to really look at what those tools are that are available to you. Now, the IRS gives you certain tax benefits if you use the tools that they have made available to you. You might have heard of a 401k or a 403b or a 457 or an individual retirement account. Those are just tools available that give you tax benefits to save for retirement as long as you keep those dollars invested until at least age 59 and a half or later. So we're going to dig deeper into those tools and understand what might work for you and really what makes them unique and helpful in saving in our retirement journey. First, we're going to look at the two main groups, employer-sponsored plans and individual retirement accounts. So 401k, what does that even mean? Why is there that number? That number is part of our Internal Revenue Code. It's just a subsection of the code saying that you're going to receive specific tax benefits if you save for retirement in this vehicle. A 401k is an employer-sponsored plan. That means you need to be working at a business that has a 401k. Now you might say, my employer doesn't offer a 401k. Maybe it's a 403b or a 457. Those are just for specific industries that you might work in. But they're all employer-sponsored plans. So you need to have payroll income, and then you're able to make contributions for retirement through payroll deductions. So each paycheck you're contributing for retirement. There's also the ability that an employer can make contributions. So maybe they offer a match, or maybe they do profit sharing. There's different ways that your employer might help you save to reach your retirement goals. Now, an individual retirement account or IRA is something that you set up on your own. It's not tied to your employer, it's in your name. You make contributions from a savings or a checking account, and you can do that maybe monthly or if you want on an annual basis. Some people do that when they file their taxes annually, they'll make that contribution. Now, the contribution limits are quite a bit different for the 401k versus the IRA, as well as those catch-up contributions. As we move closer to retirement, we're able to save a little bit extra to help us catch up to what our goals might be. Maybe we got started saving a little bit later in life. Now, an IRA only allows you to make individual contributions. So your employer isn't going to be contributing to your IRA. The investment selection can vary between the two accounts in that you have lots of options in an IRA where in an employer plan, you're limited to that plan lineup. So which one might make sense for you? It's really going to depend upon your situation. Understanding what's available to you, what are the level of service that you would like to have, what are the fees in the account, and then maybe you're self-employed and are looking, what are those options as well? It might look very different for you. But those are the two main categories of retirement accounts. Now, we talked about that they have tax benefits. That's why we're really saving in these accounts. The government is giving us tax advantages because we're saving for retirement. So let's go through those differences, remembering that both of these types of accounts allow us to have both options. Pre-tax and Roth. When we think about pre-tax, this is going to be the traditional way we've thought about saving for retirement. When somebody said 401k in the past, typically it's always been a pre-tax contribution. Or an IRA, that individual retirement account, pre-tax contributions. So what does that mean? Well, it really means that we think we're in our highest income earning years now, and that when we're in retirement, we're going to be in a lower tax bracket, and we'd rather pay those taxes in the future when we're in a lower tax bracket. So really think about that. Why does that understanding your budget matter? Why does understanding what retirement looks like to you matter? Well, because we're trying to optimize our tax situation. It's a great conversation for you to have both with your accountant and a financial professional that can help you navigate this. So when you think about that pre-tax contribution, think if you contributed $50 today, you're going to retire 30 years from now. If that $50 grows to $300, you're not paying income taxes on that $50 today. But when you retire and you start taking out that $300, you're going to be paying taxes on that $300 at whatever tax rates are at that point in time and at whatever tax bracket you're in at that point in time. So think about that. It's deferring the taxes. Now, Roth contributions are the opposite. Now, you can have Roth 401k or Roth IRA. They're just different buckets of money. So the Roth allows you to pay income taxes today. So you're saying, you know, I think income taxes are lower today than they're going to be when I retire. I think taxes are going up in the future. Or I think I'm in my lower income earning years now than I will be in 10 or 20 years from now. So if you think about that same $50, you're going to pay income taxes on that today. But if it grows to $300 by the time you retire in 30 years, you're going to take out that $300 tax-free as long as it's been in there at least 5 years and you're older than 59 and a half. So it's really determining, where do you think taxes are going? Where do you think your tax situation is? And finding a balance. We don't have a crystal ball. We don't know exactly what that situation is going to look like for you or our tax brackets, but you can allow yourself to have tax diversification and have flexibility in retirement. So we've discussed really the main tools that allow you to save for retirement, what sets them apart with the taxation, but let's go through the items that you want to focus on, that you can control. Your savings rate, taxation, and investment selection. How much should you be saving for retirement? A general rule of thumb is 10 to 15% of your income. Now, this could vary a lot. It depends upon when you started saving. It depends upon when you want to retire. And it depends upon what that retirement looks like to you. If you want to retire early, you might need to be saving more than that. Just keep in mind, it's not something you set and forget. Maybe you started a job 5 years ago. Do you know what you chose as your contribution rate? Now is a great time to review that. Maybe you started a job recently and haven't started contributing yet. Take the time to go through that process. It doesn't matter if you start at 1% or if you're at 14% and trying to increase to 15. It's a great time to get started. You can make it a habit that each year you increase your retirement savings 1 or 2%. It's a great way to make it a consistent habit that you stick with. It's often difficult if we make big changes where we jump from 0 to 10% and all of a sudden our budget feels very tight. So make those changes that you really can be consistent with and stick to. Next is taxation. We talked about that difference between pre-tax and Roth. And why does that matter in retirement? And why do we want to be thinking about that? Remember that we have a marginal tax brackets, marginal tax rate. Different dollar amounts are taxed at different percentages. The more income we make, those later dollar amounts are taxed at higher rates. So maybe there's a year in retirement where you want to take your whole family on a vacation, or maybe you're buying a vehicle and you don't want to bump yourself up a tax bracket. That's where if you would have saved Roth dollars, you'd be able to take out some dollars tax-free that year. Remember, any contributions your employer makes are always going to be pre-tax. So review that. Think about how that fits into your picture and how that can offer you flexibility in your retirement years. And then there's investment selection. Kayla talked to us about that roller coaster, the ups and downs that you're going to see in your account, as well as risk tolerance. And it's really important for you to understand what is your risk tolerance. How much can your account go up and down? And are you still okay and able to sleep at night? If you haven't looked at what your investments are in your 401k or IRA, review that. Take a risk tolerance questionnaire. Typically in 401ks, we'll see a few different options, maybe a target date fund, a risk-based model, or you'll create a custom portfolio from the mutual funds available to you. Now think about a target date fund. What does that even mean? It's really looking at everybody in your age group and saying, here's the mix of stocks and bonds you should have based on your age group and timeline until retirement. Now think of everybody in your high school class. It's putting everybody in your age group in the same exact mix of stocks and bonds. Do you think everybody in your class has the same risk tolerance? Probably not. So it's good to review and see if that target date fund, if that's what you're in, makes sense for you. If you've created a custom portfolio, but it's been a while since you've reviewed that stock bond mix that you've chosen, look at that. As you move closer to retirement, we typically become a little bit more conservative as we want more stability in our accounts. If you chose something at age 20, you probably don't want to be in that same investment at age 50 or 65. So remember, this whole process is not about setting it and forgetting it. So when we're thinking about this, it's really about freedom. When we're talking about our finances, it's making sure that we're taking control of a situation so we can have the lifestyle that we want. There's often resources that are helpful to us to make us easier to reach our goals. One of my favorites is a recent podcast from the Wall Street Journal, Your Money Briefing. On May 27th, they did a podcast about couples and risk tolerance differences. That's a great one to review if you've ever had a discussion and you differ with your significant other on how much risk you want to have in your portfolio. Now, we covered a lot of information today at a high level. And again, everybody's situation is different. So it's important to make sure that you understand where you're at and feel free to reach out with any questions that you have or ask them now, as it's very likely somebody else has the same question.
Came through is, can you have a 401k and IRA?
Yes, you can often have both. There's different rules for contribution limits and what those deductibility options are for you. So you just need to look at your specific situation and ask questions about that.